Okay, welcome trader friends. This is about Friar's silver thesis, and remember, it's not a 35-day to expiry setup. It's not a short-term trade because this is the big kahuna. Silver is currently trading at approximately $75.70 per ounce, up 128% year on year. The SLV silver ETF is at 68.79 at the moment, with Friar's Leap break even at 82.41. A 19.8% gap on the SLV price, far closer than it was when Friar first entered. Okay, we've got 6 structural pillars, all confirmed. As of this week, Pillar 3, the COMEX delivery stress, includes live data because in 3 days, the May's first notice day of wanting to take physical delivery is up. And Pillar 6, US policy, just accelerated with the US-EU Critical Minerals Action Plan that was signed on the 24th of April, last Friday. So to let you know, Friar has 300 SLV shares, a Leaps for January 2027, and some physical silver held in Sydney by Jet, my son. So we are positioned, we're not hoping, we're waiting for it. Okay, up to date for today. Silver spot price in Shanghai is $85.62, about a 12.5% premium to the COMEX near month futures price, which is $75.70 per ounce. So silver's up 128% year on year, with the 52-week range has been $25.04 up to $109.83 for SLV ETF. The high was a parabolic move in January. The current price is a consolidation phase, with the war in the Middle East creating headwinds because the USD gained some strength. However, the structural thesis is definitely still intact. SLV at $68.79 compared to the break-even, Friar's break-even of $82.41, there's a 19.8% gap. But with JP Morgan's full-year average target is $81 for 2026, very close to Friar's break-even. So we only need the market to average JP Morgan's own central case for Friar's Leaps to pay off. And we need to talk about the gold-silver ratio. Currently 55-1 with gold at 4,200. For it to get to, if it was at 50-1, then silver would get to $90. So that the gold-silver ratio by itself is another fundamental catalyst. The Leaps has 264 days to go for January 27 expiry. We've already identified 3 triggers. Only one of these needs to fire. Okay, 6 pillars, all 6 confirmed for silver. 2 pillars are now live events this week, so we're not going to be discussing historical references. We've got live events related to silver this week. Pillar 3, which we'll discuss, COMEX showing 174.8% potential delivery demand against registered silver. And the first notice day for the May contract is this Thursday. Pillar 6 in green relates to the US-EU Critical Minerals Action Plan, which was announced last Friday, a few days ago. The US trade representative visiting multiple countries simultaneously, coordinating plurilateral agreements on critical minerals supply, including silver. The policy architecture is being constructed faster than anticipated. This is not a future possibility. It's active diplomatic and legislative work happening right now. The 6 independent structural tailwinds align simultaneously. This is why it is a diamond. Pillar 1, supply deficit. The Silver Institute pegs the 2026 shortfall at 46.3 million ounces, and that's the 4th consecutive annual deficit. JM Bullion reported this figure as of the 22nd of April 2026. Over the past 6 years, there's been cumulative shortfall exceeding 500 million ounces. 6-year structural supply deficit. The critical distinction with gold is recycled. Silver that goes into a solar panel or an EV circuit board or a missile guidance system, that silver is gone, not recoverable at scale. Every gigawatt of solar installed, every EV manufactured, every AI data center built permanently removes silver from the above ground pool of supply. Demand is structural. Consumption is permanent. The coiled spring tightens every year. Pillars 2 and 3, the manipulation history. Label conspiracy theory does not survive contact with the legal record. JP Morgan RICO convictions in 2020. JP Morgan admitted in open court they were guilty and some of their punters went to prison, and that's a rare thing. Deutsche Bank 2016, $60 million settlement, and they provided evidence against other banks for being dodgy. COMEX system halts. We'll remember them twice. One was, I think, New Year's Eve, and one was American, what do they call it? Thanksgiving. Dodgy as hell. The market pauses specifically while institutions restructure their holdings. It's closed to retail. And in fact, expect it on, I think it's this Wednesday. There's quite possible the system will go down again because there's not enough silver for them in COMEX. Okay, 2011, 5 margin hikes in 8 trading days. Silver falls $33. Surgical, directional, regulatory mechanism used as a price weapon. All of this is on the public record, the public docket. It's not conspiracy theories. The question is not whether silver has been manipulated. It demonstrably has been. The question is what happens when 40 years of suppression meets a physical delivery crisis. The next slide will answer that. This is not history. This is happening now as we speak, as I'm making this. Registered silver, the only metal actually deliverable against futures contracts, stands at 77.1 million ounces, down 2.7% in a single day, down 60% from the September 2025 peak. Open interest is 552.9 million ounces in paper claims. Delivery coverage ratio is only 13.9%. The COMEX dashboard itself is labelling stress in big red. Potential delivery demand for May alone, 134.8 million ounces against the 77.1 million that's registered at COMEX. That's 174.8% gap. That's extreme delivery pressure. The paper leverage is 7.2 times. For every ounce of real deliverable silver, there are 7.2 paper claims. COMEX stress index is 63, which shows elevated. Look at the chart in the middle. The blue line is a near vertical decline since January 2026. Look at the dashboard on the right. The system is flagging extreme delivery pressure with 3 days to first notice. That's extreme. Thursday, if contracts stand for delivery rather than rolling, with a 13% China premium available, the incentive is to stand for delivery is increasing. We will see whether COMEX can source the metal. They can't. A single high-profile failure breaks confidence in the paper system. This is a trigger that Friar identified in the thesis previously. It's not hypothetical anymore. It's 3 days away. Thus, Friar is predicting on Wednesday, COMEX system will go down for several hours while they try to negotiate with the paper owners not to stand for delivery. Pillar 4, inelastic demand. Inelastic means the price does not kill the demand. If price doubles, solar panel manufacturers do not stop making panels. The silver content is a small fraction of the total cost. Solar, approximately 20 grams per panel. There were record installations in 2025 and 2026 so far. Every panel removes 20 grams from the available pool permanently. Electric vehicles, 30 to 50 grams. So what's that? 1 to 2 ounces basically per vehicle. Every EV permanently removes silver from the above ground supply pool. The military, precision missile guidance circuits require silver contacts. No substitute at the performance level required. AI data centers, hyperscalers are not slowing their infrastructure build out. Every facility is silver intensive. Silver does not come back. The above ground recoverable pool shrinks with every application. The demand is structural. The consumption is permanent. The deficit compounds. Pillar 5, China. Two things simultaneously. China is offering around the 13% above COMEX paper price to secure physical silver. At the same time, China has imposed export restrictions. A nation that mines and consumes enormous quantities is restricting outflows. The largest player in the silver market, buyer, producer, consumer, China, is paying up around 13% above paper price to accumulate more, while stopping silver from leaving the country. A nation does not offer a 13% premium out of generosity. China is front-running a revaluation it expects. It's using sovereign capital to signal that the current paper prices are significantly below true value. The 13% premium is the market clearing price, not COMEX, not LME, and it is 13% above what COMEX says silver is worth. Okay, the next slide we'll have a look at Western policy response to this behaviour. Pillar 6, and this is the pillar that has moved most dramatically in the past 48 hours. Hot off the press, Friar says. The original thesis flagged US critical mineral designation in November 2025 and the US-Mexico Action Plan as two confirmed steps with stockpiling and tariffs as pending. However, as of the 24th of April, last Friday, 2026, a few days ago, US Trade Representative Ambassador Jamison Greer announced the US-EU Action Plan for Critical Minerals Supply Chain Resilience, alongside EU Trade Commissioner Zhigniew. The USTR press release is on the slide. The key language, a binding plurilateral agreement, border-adjusted price floors explicitly discussed, non-market policies and practices that have distorted critical mineral supply chains, diplomatic language aimed squarely at China's pricing behaviour and export restrictions. US plus EU is the world's two largest manufacturing blocs, coordinating simultaneously. Combined GDP of approximately $35 trillion, combined silver consumption represents the majority of industrial demand globally. The USTR is visiting multiple countries simultaneously. This is a coordinated diplomatic offensive to lock in Western critical mineral supply chains before China takes more control of them. What was policy flaw under construction in Friar's original thesis is now policy flaw being actively built with multiple partners simultaneously. So the pace is accelerating significantly. The two pending steps, stockpiling, activation and import tariffs, still remain. But the architecture to execute them is being built faster than anticipated. Okay, next, the physical delivery squeeze, the demand side of the thesis. JP Morgan ranks highly here. The largest silver short in history at $13.7 billion estimated exposure JP Morgan had. And then in January 2026, silver tripled on them. JP Morgan issued 99% of 8 million ounces in a single day's delivery notices and began accumulating long positions. The institution most responsible for suppressing the price has flipped to the long side. When the biggest shorter decides suppression is over, that is a signal. Sprott doubled their capital raise to $2 billion, 16% of COMEX registered inventory in a single institutional move. The dodgy Jane Street had a 500-fold increase in their SLV holdings in a single quarter. They're arbitrage players and have identified structural mispricing. They are positioning for a reconsolidation between paper and physical. And Friar's SLV shares sit inside this picture. Every share is allocated physical silver held in custody. So Friar's on the right side of the trade. 3 triggers. Only one needs to fire. As of today, Trigger 2 is live and Trigger 3 is actively being built. Trigger 1, Fed pivot, the yield peaks SLV at 68.79, break even 82.41, 20% from current SLV price. Silver historically outperforms gold 2 to 3 times in late cycle, so watch the 10-year and the dollar index. Trigger 2, COMEX delivery failure, 174.8% potential delivery demand against registered supply. It's this Thursday. If contracts stand for delivery rather than rolling, we will find out whether COMEX can source the metal. Trigger 3, US policy action. The trigger has upgraded from pending to building because of the US-EU action plan that was signed on the 24th of April, which is basically agreeing to a floor price being accepted by these nations for critical minerals. Friar's Leap, expiring January 22nd, 264 days, 3 triggers, only one needs to be hit.